Is private credit going to take us back to 2008? Should you buy this big dip in software stocks? Today, we're really excited to be talking to Steve Eisman, a legendary investor and financial analyst best known for his prescient bet against the US housing market prior to the 2008 financial crisis, a story chronicled in Michael Lewis's The Big Short. He's going to tell you the most accurate and timely way to read the health of the US economy and why the stock market is so high right now despite the war. You especially don't want to miss his thoughts on whether today's AI giants are going to succeed. Let's dive in. We're really excited to have Steve Eisman on the show today. Steve is a renowned investor and financial analyst, best known for his prescient bet against the U.S. housing market prior to the 2008 financial crisis, a story chronicled in Michael Lewis's The Big Short and played by Steve Carell in the film adaptation. With over 20 years of experience, he has held senior roles at Oppenheimer and Company, Front Point Partners in Neuberger and Berman, and currently hosts the Real Eisman Playbook podcast, where he shares market insights, investment strategies, and conversations with leading voices in finance. He holds a bachelor's degree in economics from the University of Pennsylvania and a Juris Doctor from Harvard Law School. Steve, welcome to the show.
Thanks for having me.
I guess the first thing that I do want to ask you about is, and many people know the portrayal of Steve Carell. How did the movie come about? How did you get into that movie?
My participation in the movie is extremely limited. Michael Lewis contacted me in probably late 2008 and came to see me. We had a conversation. He then wrote an article about me and then eventually turned that into a book. I probably spoke to Michael about a dozen times for the book. And then the rights to the book were bought by Brad Pitt's company, Plan B. Nobody heard from it for years. It just sort of died. I thought that the movie was never going to happen. And then I got contacted by Michael, I think in 2014, some point, to say that Adam McKay, who had been the head writer at Saturday Night Live many years before, had loved the book, had written a script, everybody loved the script, and he was going to direct. And I figured that was utter nonsense. But he said Adam McKay was going to call me and say, okay, Michael, nice talking to you. And a couple of days later, Adam McKay called. And we had a conversation, eventually had dinner. He said that there was a very strong possibility that Brad Pitt was going to play me. I told him the only thing that Brad Pitt and I had in common was we both have really good hair. I had more hair back then. And then it turned out that Brad Pitt had a scheduling conflict. He couldn't do it, and Steve Carell played me. I met Steve Carell really only once. We had breakfast in a diner near my home in Manhattan. And that was really my only involvement in the movie.
So did you help pick the name Mark Baum, or did the screenwriters come up with that?
My wife and I decided we did not want to have our names used. And so they picked the name.
Yeah, it was really, I could imagine how different it would have been if it had been Brad Pitt, just a whole different character, I think, in the movie.
A totally different character.
But it worked out really, really well. And, I was with Lehman Brothers when it went down, and I thought the movie I thought the movie was great. Literally the only thing I thought that was not accurate was at the very end when they went up to the Lehman trading floor and it was empty. It was never empty. We had no place to go. And
right.
The Bloombergs worked and the cafeteria was open. So everybody showed up and it was just like trying to figure out what was going to happen next. That was the only thing. But it was really a wonderful, wonderful movie. You have a degree in economics from UPenn, and then you get a law degree from Harvard Law School, but you go back into finance. What was the thinking behind Harvard Law School?
There wasn't a lot of thought. I went to law school because I thought it was a good idea. I loved law school, loved it. And I hated being a lawyer. I practiced corporate law for about 2 years. I was completely miserable. And I got a job at Oppenheimer as a junior analyst in early 1991 and kind of fell in love with Wall Street.
So certainly the action is very, very different. What you do seems to really matter quite a bit. One of the things that we're dealing with a lot today is this private credit crisis. And if you look at it, on the surface,
I don't know if I'd call it a crisis.
Absolutely fair. On the face of it, the sizes aren't all that different, but certainly, these aren't banks. They're not rolling over, sort of things day to day, week to week. Is there really, to be fair, a real parallel between what we saw in 2008 and private credit today? Or maybe is it something more like the savings and loans in the sort of early to mid 80s?
Well, I mean, let's size the problem for a second. The issues, well, let's back for a second. The last time there has been any real credit losses in the United States was the great financial crisis. So we've had 17 years of absolutely pristine credit. Pristine. I mean, shockingly so. So it's been a wonderful time to be a lender because the way that business works is you charge an interest rate on a particular type of loan based on an assumption about what the future losses are going to be. So if you think the future losses are going to be X, you're going to charge an interest rate of Y. If you think the future losses are going to be X plus 200, you'll charge interest rate maybe of X plus 300. That's just how the business works. So if you're a lender and losses come in below X every single year, you're making excess profits. And the lending business, whether it's private credit or not private credit, has been making excess profits basically for 17 years. It's been a wonderful time to be a lender. And the question everybody has is it over? Private credit is a very large business, but the part that we're talking about is the direct lending part of private credit. And what we're talking about are basically private credit funds that make loans to private equity to buy companies. That's about a $2 trillion a year business. And the private equity industry went on a buying binge of software companies between 2018, probably through 2023. So a very significant portion of private equity today is in software. And because of that, probably 25 to 30% of private credit funds that do direct lending, which is this $1.2 trillion, about a $2 trillion industry that I talked about, is in software. So call it 30% of $2 trillion. It's several $100 billion. Maybe it's $500 billion is what we're talking about. That's not calamitous. I mean, it's certainly not great for the people who have those loans, which we'll talk about that in a second. But the other thing I would just point out, which is very, very important, is that, pre-financial crisis, the very large banks in the United States and Europe were levered 40 to 1. So when you're levered 40 to 1, the math is such as you don't have to have big losses to get wiped out because the leverage wipes you out. Private credit funds aren't anywhere near levered like that. They're probably most levered 2 to 1, probably something like that.
I didn't even realize they were levered.
Well, BDCs, which are allowed to lever like 2 to 1. How much the non-BDC private credit funds are allowed to lever? Probably maybe more, but not that much more. Well, let's just call it 2 to 1. It's not, 2 to 1 is not terrible. It's certainly not 40 to 1.
Certainly not. For our viewers, BDC is
Business Development Corporation.
Okay.
It's a technical type of corporation. Many of them are public. Some of them are not public. It's a company that's designed to make loans. So some of them are public companies like Maine or Hercules. And then there are, Blackstone's BCRED, which is the largest private credit fund in the industry, which is about $82 billion, is technically a private is technically a business development corporation, but it's just private, and I'm imagining it's levered 2 to 1. I mean, look, the issue with when you compare it to the financial crisis is when banks are levered 40 to 1. What happened during the Great Financial Crisis? Everybody was worried that the banks were going to evaporate, and that would have meant you go to the bank and you can't get your money. That's the end of planet Earth. Okay, lights out. And that's why the government had to come in and bail everybody out. You're levered. So first of all, these are not banks. The people who are investing in these funds are going to have issues, which I'll talk about in a second. Mm-hmm. But you're levered 2 to 1. Now, a lot of that leverage is provided by banks, but the banks are far less levered than they used to be. So if you could compare the way banks are levered today versus the way they were levered pre-crisis, it's less than half. Leverage is less than half. I mean, the way I like to say it is the banks of the United States have never been this well capitalized. Human history. Let's put it that way.
So in that regard, the government did a good job in terms of making them better capitalized.
And the funny thing is that the person who did that job was Fed Governor Daniel Tarullo. He was vice chair of financial supervision. He did that from 2011 through, call it April 2016 when he resigned. And the irony is that while he was doing it, people like Jamie Dimon and all the other bank CEOs were yelling and screaming what an SOB he was. He was terrible. He's killing us. And today, if you said to them quietly, what do you think about Daniel Tarullo? They'd all say, thank God. Thank God he did what he did. So the banks are very healthy. Are people going to suffer losses? I mean, the issue with software, it's a very interesting sort of intellectual problem. You have all these software companies that were taken private, and they were taken private at basically peak multiples. So I'm imagining every single one of these people was taken out at some PE of 25 times plus. Because of AI, there is this fear in the marketplace, AI is going to wipe out the software industry. I had a great guest on my podcast a couple of weeks ago where we talked about the issues and basically what he was a sell-side analyst. And basically what he said is it's so early you could say anything. But the fears run from companies will internalize a lot of software projects because it's so cheap to make software now, to there'll be fewer seats, to you won't be able to raise prices anymore. The software stocks have been obliterated in the last year. Today, for example, just as an example, Salesforce, which is, as we all know, an iconic software company, multiple is like 13 times. So for the first time I can't remember when, but certainly decades, software companies are selling at market multiples that are less than market multiples. Whereas when all these deals were done, they were much higher than market multiples. So look, I think it's safe to say that private equity, which bought all these companies at peak multiples, the valuations of these companies are less than half.
Wow.
Period. So less than half. And I don't care how well or how badly any of them are doing. It doesn't matter. When Salesforce, which used to sell it at more than 20 times PE, is selling it at 13 times PE, and the PE has been cut by more than half, anything that you bought in software is less than half. And the decline, if you were to just run down all the software stocks out there, it's been indiscriminate. And just to give you how fearful people are, so we're talking on April 24th, the evening of April 22nd, after the market closed, ServiceNow. ServiceNow is another iconic software company. ServiceNow reported earnings, which on the surface were perfect. They had 20% EPS growth. It was better than expected. Revenue growth, get this, for a company that size was 22%. I mean, that's amazing. 22% revenue growth is pretty astonishing, especially for a company that size. And then they had a sentence in the press release. And the sentence basically said they had that in their subscription business, which is most of their business, they lost 75 basis points of growth. Deals in the Middle East got delayed because of the war. That's not shocking.
Seems reasonable.
And they still beat numbers, and they still had 22% revenue growth. Now, so normally the market would have looked at the numbers and just shrugged that off. But given how precarious the narrative is in software, there is no shrugging in software. The stock was down 14%. So I like to say sometimes software is a sector right now that goes down on good news, bad news, and mediocre news. It just goes down. Now, it had a rally for the last 2 weeks because people were bottom fishing. And the people who bottom fished just got their heads handed. I mean, it's not ServiceNow is not the only stock that went down on yesterday. The whole group got tattooed. If you're private equity, you've got a problem because you've got a very significant percentage of your portfolio in software, and there's no solution. I mean, half is half. There's nothing you can do about it. As far as private credit is concerned, the issue is that about 11% of these loans will come due next year and probably another 20% in 2028. Who's going to want to refinance these loans when the valuation of the company is less than half? That's what's coming. Is this the biggest credit calamity in the history of planet Earth? It certainly is not. Now, what everybody was concerned about was maybe this was a harbinger, like a kind of a canary in the coal mine situation where, okay, we got issues in software and it's spreading to other things. So what happened was the banks all reported last week.
Great reports.
Large bank. And they were great reports. And
Except
I went through
Wells,
them
maybe.
with a fine-tooth comb. And, the nice thing about the banks is they provide a tremendous amount of data. Tremendous. It's, when you go through JP Morgan's 28-page deck supplement, there's no mystery about how's credit quality. It's all right there on the page in pretty nice detail. And, I went through all the large banks. The data is benign. In some cases, there was year-over-year increases in non-accrual loans, but not much. In the case of Bank of America, it was actually down year-over-year. But so there was literally nothing you could point to in the bank reports that would say to you that the United States is on the verge of a recession. I would not want to be a private credit fund that owns all these loans or a private equity firm that owns these companies because you're stuck. But we'll see.
So I'm just briefly on the software, and then I do want to talk a bit about AI as well. Do you think this software thing is ultimately overdone? Are we really going to replace Microsoft Excel with something that AI wrote? Because if you get Excel wrong somewhere deep in there, it's going to be really, really bad. So
I actually think you're not. The bull case. The reason why software stocks were such great stocks for so long is decades ago the industry used to sell software. Here's the software
on a disk, right?
On a disk, and pay me for everything up front. Think of it almost like as a book. You put so every quarter it was like an adventure as to what software earnings would be, because the revenue growth could be 5%, it could be 10%, it could be 12%, it could be negative 2%. It all depended on how sales went during the quarter. And so then the industry switched to the SaaS models. Software as a subscription service.
Genius.
And genius. And so what that basically meant was you sell somebody software, they don't pay anything up front. They pay you quarterly. Never underestimate the importance of an Excel spreadsheet in the valuation of companies. Because prior to SaaS, if you were going to model a software company, all you would do is take the revenue from the last quarter and you would say, okay, I'll take the revenue from the last quarter and I'm just going to guess what the revenue growth is going to be, and that's my revenue estimate. And 99 times out of 100, you were not even close. But with the SaaS model, what happens is the model becomes much more elegant and much more predictable. And the way it works is you have the ending number of seats, and then you make an assumption about how many seats you're going to grow by. So you have new ending seats, and then you average the two. So what are the average number of seats for the quarter? And then you multiply it by last quarter's average price per seat, which is not going to change very much per quarter. And so it's much easier to model the company. Because you're charging quarterly, it doesn't seem like you're raising price that much when you raise price for what people are going to charge per quarter. So
boiling the frog slowly.
Right, boiling the frog, exactly. So the bull case for software for years was the model's very predictable in my Excel spreadsheet. The number of seats goes up every quarter, and pricing goes up every year. Even if the incumbents do fine, I think the number of seats may be questionable because there are going to be a lot of layoffs. It's going to be harder to raise price because there is no question that the cost of creating software has come down a lot because of AI.
So you might get margin compression. You may have similar seat, but the margins may not be as robust.
Margins may not grow. I don't know. but it's so much up in the air. The fact that, like I said, ServiceNow could go down 14% on news like that is pretty astonishing.
So IGV, I guess, is the big software ETF. Is it a buy at these levels, or are we trying to catch a falling knife?
I'm not courageous enough to make that decision. That's like catching a fall. And like I said, people tried to bottom fish 2 weeks ago. They looked good for 2 weeks, and then they got their heads handed to them. I just think the narrative is so negative, and we won't know. We won't really have any clarity for at least, I think, a year. So until then, it's like, to me, it's more like you're rolling dice. That's not what I do for investing.
And rolling dice, you usually lose at the casino. So there's a statistic that seems to be accurate. I looked into it and I wanted to see what you thought. That some folks said that the third years in presidential terms in the last basically century, except in two instances, have been generally very, very good years, the best years of a presidential term. The evidence seems to be, good about that. But do you see that happening again? So next year we'll have, maybe we're 8,000 at the S&P 500.
Like I said, as long as there's no recession and the economy is fine, I think the market goes up. I don't think it's any more complicated than that.
Just to go back to your bank credit credit health. How in the past, how quickly have you seen a deterioration in the bank, sort of bank credit balance sheets, and then a recession that follows it, or something substantial that follows it? Like how long of a
it can happen pretty quick. It can happen pretty quickly. Consumer credit, commercial loans are very long lived, and so there are issues involving commercial real estate that have been going on for years, but banks can extend and pretend. And so those things take really long time to sort of evolve. But when it comes to consumer credit, if there are layoffs, when it comes to big commercial loans, a bank can renegotiate, they can restructure, they can do lots of things so that the loan stays good for longer. You can't do that with millions of people. I mean, what are you going to do? Send everybody a letter? It doesn't work that way. So if all of a sudden, people get laid off and they start having problems paying their credit card bills, they just have problems paying their credit card bills. The credit card industry is not going to restructure all of its credit card loans. So that tends to happen pretty quickly, so the feedback loop from layoffs to problems in credit is pretty quick.
It seems that you get the stories are terrible, especially for the for the youth, and then you see weekly claims; they just don't move. It's in the low 200s.
Like I said, the story for the last 17 years has been how resilient this economy has been.
Moving away from the U.S. a little bit, and we, our audience is heavily Korean. Do you look at the Kospi? Do you look at Samsung's and SK Hynix? I mean, these things have gone stratospheric. Sorry,
I used to. I used to when I was running my hedge fund at Front Point. Our portfolio traded 24/7. We were like everywhere. We were in Asia. We were in Europe. I found it emotionally exhausting. Just exhausting. I would experience this. This would happen every couple of weeks. I would wake up in the middle of the night at 3 a.m. Undeniable urge to look at my computer to see how my portfolio is doing. and 99 out of 100 times, I could not resist that urge. And so I would open my computer when I would log in, and I would see how my portfolio was doing. And it wouldn't matter whether the portfolio was doing well or not doing well. I could never go back to sleep. And I decided after my Front Point years, I'm done. There's plenty to do in the United States. And so, I look a little bit about what goes on in foreign markets, obviously. I mean, Korea's market obviously has done extremely well. Me personally, I just invest in the United States.
Do you look at any alternatives, thoughts on gold, on crypto?
I am not a gold guy. Crypto is, I find, bewildering in the sense that it acts opposite to its own thesis. Like if you sit down with a crypto person and you say to them, why do you own crypto? What's your thesis? And they'd all say the same thing. It's kind of like a digital gold thesis. Fiat currency, which is government currencies have been debased, deficits are very large, So you want to own crypto as a hedge against the debasement of fiat currency. And that's the thesis. And the problem is, if that's the case, then on days where everybody's worried about war and they're worried about inflation and they're worried about interest rates, crypto should go up. And on days where NASDAQ is up huge and interest rates are down, crypto should go down. And it acts opposite to that. It's the correlation of crypto to NASDAQ is exceptionally high. It's like 75%. It's not a hedge. I don't know what it is, but it seems like it's just a way to speculate about speculating.
You're right. And what's stunning, and I've been a metals trader for a long time, is metals are now heavily correlated to the S&P as well. Sort of gold goes up when the stocks go up, and you're like, this is actually quite strange.
It should not be.
Right.
So if somebody look, it'd be sort of like this. Let's imagine I recommended to you, let's buy Capital One, credit card company. So you'd say, what's your thesis? I'd say, well, my thesis is I think credit quality is going to get better. So the loan loss provision is going to go down and the earnings are going to double. And that's my thesis. And let's say it turns out that credit quality got better, earnings doubled, and the stock collapsed. I'd say, I don't know what I'm doing. I'm clueless. I have a whole thesis. It worked out perfectly. And the stock did exactly the opposite. That's how I feel about crypto. I don't know what the thesis is to own it.
My thesis, I own a small amount of it. I look at it as I don't know. It's kind of bewildering. There are too many. I only look at the top handful of them because the rest I just don't know. I think of it as sort of a fat tail asset. Maybe something really spectacular goes on sometime that I can't figure out. And it's small enough that if it really just goes pear-shaped, my life really doesn't change. And that's why I sort of think about it. Any names, any sectors that you feel particularly strongly about, in the short to medium term that you like or that you want to be very careful about?
The only thing I would just tell your viewers is to be careful of software. It's like catching a falling knife. I get a lot of questions from my viewers about whether they should buy software stocks, and I just say, tread carefully. It's too hard because you're finding a very negative narrative, and negative narratives are very hard to flip.
Steve, thank you so much for joining us. Look forward to having you again on the show soon.
Thank you. Anytime.